I want to do some quick maths with you. Say you are $5 short of covering a grocery shop. You are expecting money to come in tomorrow, so your bank covers the $5 for you. Very generous. The average overdraft fee in the United States right now is $26.77. So you borrowed $5. You paid $26.77 to borrow it for 24 hours. Let's calculate the annual interest rate on that transaction. $26.77 fee on a $5 loan for 1 day. Annualized. That is an interest rate of approximately 195,000%. Not a typo. 195,000%. Your credit card, the one everyone warns you about, charges somewhere between 20 and 30% annually. The most notorious payday lenders in America, the ones that are regularly called predatory, charge around 400% annually. Your bank, covering a $5 shortfall for 24 hours, charges the equivalent of 195,000%. And in 2024, U.S. consumers paid $12.1 billion in overdraft and NSF fees. Total. So the question is, how does this keep happening? And what do you do about it? If you have ever been charged a fee for being temporarily short of money, you were not penalized for being irresponsible. You were targeted by a business model specifically built to profit from that moment. According to CFPB data, roughly 9% of checking accounts are overdrawn 10 or more times per year, and those accounts generate approximately 79% of all overdraft fee revenue. 9% of accounts, 79% of the fees, the same people, month after month, the same moment of being short, over and over. This is not an occasional inconvenience charge. It is a recurring revenue stream built on financial vulnerability, and knowing that is the first step to opting out of it. So let's go inside the machine, because understanding exactly how your bank makes money from you is the only way to stop it from happening. And the moves that stop it are simpler than you think. Revenue Stream 1. The interest rate spread. Your bank takes the money you deposit and lends it out to other customers at a higher interest rate. The gap between what they pay you for your deposits and what they charge borrowers for loans is called the spread. It is their core business. Here is what that looks like right now. If you bank with one of the 4 largest U.S. banks, Chase, Bank of America, Wells Fargo, or Citibank, your standard savings account pays approximately 0.01% interest annually. Not 1%. Not 0.1%. 0.01%. On $5,000 in savings, at 0.01%, you earn 50 cents a year. The personal loan rate from the same bank? Around 11%. They borrow from you at 0.01%. They lend to someone else at 11%. The 10.99% gap is their profit, generated entirely from your money while it sits in your account. Revenue Stream 2. Overdraft fees. Emma is 23. She works 2 part-time jobs to cover rent while she builds her career. On the 14th, the day before payday, she bought groceries. $43. Her account had $38. Her bank covered it, and charged her $26.77 for the service. The same thing happened 3 more times that month. Small shortfalls, small purchases, each one covered, each one charged. Emma paid over $100 in overdraft fees that month. Her bank reported a strong quarter. Emma is in that 9%. The customers whose financial stress is, functionally, a product that the bank sells. Revenue Stream 3. Minimum balance fees. Many traditional checking accounts charge monthly maintenance fees if your balance falls below a threshold, typically $1,500 to $2,000. The customers who maintain that balance pay nothing. The customers who cannot, the ones with the least money, pay a fee for not having enough money. The fee structure is literally backwards. The people most in need of financial services pay the most for them. The fee structure of most traditional banks is not accidentally tilted. It is a designed system that extracts the most revenue from the customers with the least money. That is not cynicism. That is the published business model. And it is currently running quietly in the background of most people's bank accounts right now. And the fees are only part of the story. The real money your bank is silently making from you happens every single day, whether you are overdrawn or not. And it is the easiest thing in the world to fix, once you know about it. The Federal Reserve's benchmark interest rate currently sits at approximately 4.25 to 4.5%. That means the economy is operating in a meaningful high-rate environment. Banks are earning strong returns on the money they lend and invest. What are they paying you on your savings account? If you bank with one of the major U.S. banks, approximately 0.01% on a standard savings account. Meanwhile, high-yield savings accounts at online banks, Marcus by Goldman Sachs, Ally, SoFi, Discover, are currently paying between 4.5 and 5% annually. On the same $5,000, the same amount of money, the difference is $250 a year versus 50 cents. The money is available. The rate exists. The only reason most people don't have it is that nobody told them it was there. Emma switched her savings to a high-yield account 6 months ago. She now earns $18 a month in interest on a balance of $4,300. That is $216 a year. For doing nothing except moving money between 2 accounts on a Saturday afternoon. Her old bank sent her an email about a new credit card the same week. Here is exactly what to do. Not vague advice. The actual accounts and the actual moves, all of which are free. Switch 1. Move your savings to a high-yield account today. Best current options in the U.S. Marcus by Goldman Sachs, Ally Bank, SoFi, Discover Online Savings. All currently paying between 4.5 and 5% APY. All FDIC insured. Your money is as protected as at any major bank. All free to open. All free to use. The process takes about 15 minutes online. Keep your existing checking account for daily spending. Move your savings over. Start earning real interest immediately. Switch 2. Move your everyday banking to a fee-free account. If you are paying monthly maintenance fees, switch. Chime, Current, and Ally all offer free checking accounts with no minimum balance requirements and no monthly fees. Chime also offers SpotMe, fee-free overdraft protection up to $200 for eligible customers. Emma's $5 grocery shortfall, at Chime, would have cost her absolutely nothing. Switch 3. Opt out of overdraft coverage on your debit card. You can call your bank today and ask them to remove standard overdraft coverage from your debit card. What this means: if you try to spend money you don't have, the transaction is declined. You feel briefly embarrassed at the checkout. You pay 0 fees. Most people don't know this option exists. It has existed since 2010 when the Federal Reserve required banks to get explicit opt-in consent for overdraft coverage on debit cards. Most banks never loudly advertise the opt-out because the fees are profitable. Switch 4. Automate a small savings transfer on payday. Set up an automatic transfer, whatever you can manage, even $10, from your checking account to your high-yield savings account on the day you get paid. Before you see the money. Before you spend the money. You adjust your week to what's left. This is called paying yourself first. It is one of the most consistently effective savings habits in personal finance. It takes about 4 minutes to set up. Emma made all 4 switches last year. She now earns interest instead of paying fees. Her $100 a month overdraft habit costs her nothing, and her savings are growing at 4.8% while she sleeps. Same income, same city, same cost of living, different knowledge. Start today. Open your banking app, find the overdraft settings, or call the number on the back of your card, and opt out of debit card overdraft coverage today. Then Google Marcus Savings Account or Ally Savings Account and open one. Takes 15 minutes, costs nothing. You are now earning real interest instead of 50 cents a year. Your bank is not your enemy, it is a business. And like any business, it will charge you as much as you allow and pay you as little as you accept. Emma paid $100 in fees the month she did not know any of this. She paid 0 the month after she did. Same income, same habits, different information. That is exactly what this channel is here to give you. Next video, we are getting practical in the most direct way possible. If you have $100 right now, and you are under 30, I am going to tell you exactly what to do with it. Not general advice, the specific order, the specific accounts, the specific decision tree based on where you actually are. That is next. Quick note before you go. Everything in this video is for educational purposes only and is not financial advice. All statistics come from verified public sources including Bankrate 2025 Overdraft Fee Survey, Financial Health Network Overdraft NSF Fee Report 2025, CFPB Federal Register Overdraft Lending Rule December 2024, Federal Reserve Interest Rate Data 2025, FDIC Insured Institution Data. For advice specific to your own situation, please speak to a qualified financial advisor.